Hi there, and thanks for joining us for the Meet the Manager session with Firetrail Investments and Solaris Investment Management. My name's Kyle McIntyre, and I'm really excited to introduce you to the first speaker today, Blake Henricks, Deputy Managing Director at Firetrail, who are experts in high conviction investing. Today, we're going to cover off on Australian equities, where are the stocks and sectors to watch. Blake will speak for 10 minutes. And then we'll have Michael Bell from Solaris speak for 10 minutes, and then we'll do Q&A at the end. Throughout, you'll have an opportunity to submit your questions, so please do so, and I'll host the Q&A at the end. Blake, I might hand over to you if you can please share your presentation screen and run us through your investment ideas and thinking at Firetrail.
Absolutely. Thanks very much, Colin. It's a real pleasure to be here for the Morningstar Meet the Manager. Thanks very much for your time today. So my name's Blake Henricks. I'm one of the portfolio managers of the Firetrail Australian High Conviction Fund. It's a concentrated strategy with a proven track record. Now, normally when you see these presentations, we talk about how good we are. But this is going to be a little bit different today because the past year's been quite tough for the strategy and for investors. But we are optimistic. And what I wanted to do today was share with you, I guess, some of the research we've done on some of the key things that have hurt us, why we've doubled down on our research and believe the positioning is right, and why we do expect to continue to bounce back. Now, I wanted to touch on three areas. The first is one where we don't see opportunities. Spoiler alert, it's going to be on the banks. Secondly is an opportunity with both quality, growth, and value. And then finally, an out of favour, big opportunity in the cyclical space. Let's get into it. We find it really hard to generate a compelling investment case for the Australian banks. If you look at what the banks have delivered in terms of earnings per share over the past decade, you can see why. You can see the yellow line there. That's Commonwealth Bank, Australia's best bank, also the most expensive bank in the world. But you can see the earnings have broadly been flat over the last decade. If you lump NAB, Westpac and ANZ, who really don't have the same software and systems as CBA, you can see their earnings are down close to 20% over that decade. And there's been three big eras of the banks. So the good times were 2000 or 2008 when you had really strong economic growth. Then in the GFC, you had massive consolidation, things that just wouldn't be allowed today. As an example, CBA bought Bankwest, St. George and Westpac merged. I mean, those kind of things just would not happen today. And the reason they wouldn't happen was because after those things did happen, earnings were very strong again for the banks. But since 2014, you've seen the rise of competition. The likes of Square or Block or Afterpay, however you want to cut it, they started in around 2014. But you've also seen some of the lo-fi new entrants like a Macquarie who've taken significant share and put a lot of pressure on the banks. So as we see it, the outlook now is high competition in key profit pools. That could be residential mortgages, it could be business loans, also transactions and working capital solutions, and cost inflation is embedded. We're seeing banks talking about some of their technology costs through the likes of Microsoft growing double digits. So competition remains fierce and it's really hard to find reasons to own the Aussie banks. But you might say, well, geez, the valuations, how do they look? Well, surprisingly, they have accelerated. And so CBA is trading over 20 times PE, which really hasn't happened through history, except for when these banks were growing at double-digit earnings per share growth. We think they look stretched because bad debt forecasts look very low, lower than the pre-COVID lows. The earnings per share are flatlining, as I've described. Return on equity is actually declining faster because banks have had to hold more capital over the last few years, and share prices are at or near all-time highs. In fact, I just had a look, and of the top 6 most expensive banks in the world, Australia have 5. And I'll put Macquarie in that number too, but the big 4 banks are in the top 6. So it's quite amazing, and we don't think the bank multiples can be justified. Now, one area where we do think we see a lot of value, or we do see a lot of value, is ResMed. And so CBA, I've plotted that there, the yellow line. It's like Halley's Comet. We just haven't seen ResMed and CBA trade on the same multiple since listing in 1998. So you'd say on the surface, given ResMed has delivered really strong earnings growth over a long time frame, they operate in the really robust healthcare space and are a market leader, it's quite surprising that Commonwealth Bank and ResMed would trade on the same multiple, particularly when you look back through history. So let's dive into ResMed a little bit more. Why is it trading at the same multiple as the Commonwealth Bank? Well, the overhang for ResMed is weight loss drugs. Now, I'm sure many of you know what ResMed do, but they are the market leaders in sleep. They produce and distribute sleep apnea machines or CPAP machines, as they're called. It's usually a mask with a motor, and it will stop sleep apnea. And sleep apnea is a dreadful condition. It's where you suffocate in the middle of the night. And ResMed's been a market leader there for a long, long time. In fact, they've got, at the moment, over 85% market share. But ResMed's been out of favour because of weight loss drugs. And 80% of ResMed's customers do have a weight problem. But we've got a few challenges to the idea that you should sell ResMed because of weight loss drugs. And these are the names like Wegovy, Mounjaro, and Ozempic. The first question you've got to ask is, will the cost come down from $1,000 US per month out of pocket? That's very steep for anyone. We think the prices will come down, but it's still, there are some cost challenges, we think, for consumers. The second is, will people continue to take weight loss drugs? This is a major question we've got and reservation. You need to be taking these drugs regularly, otherwise the weight will come back on thicker and faster than it left. And then finally, CPAP machines eliminate sleep apnea. Weight loss drugs, it's just been shown, don't. They can reduce some of the symptoms, but you still will have sleep apnea. Now, why we like it, it's because they are the market leader. In fact, one of the most compelling competitive setups we see globally is with ResMed. Previously, in the CPAP device space, there was really two players, ResMed and Philips. Philips are now going to be out of the US market for 2 to 5 years. That's in addition to them being out of the market for the last 2 years. You can see the earnings growth that ResMed has delivered, very different to what we saw with the Commonwealth Bank, and ResMed really are delivering. Now, long-term threats like these weight loss drugs typically make for great investment returns. And I just wanted to touch on JB Hi-Fi very quickly because we've got a really good analogy for what's happening with ResMed and what happened with JB Hi-Fi. In 2018, JB Hi-Fi had an existential threat, and that was Amazon's entry into Australia. Now, I'm sure you remember it. You probably know it now today. Amazon, it's one of the most popular retailers online. I certainly use it quite actively, and so does my family. But the fears at the time of launch in 2017 were that sales of JB Hi-Fi would decline, they would lose market share, and margins would decline. Because why would you buy a HDMI cable for $20 when you can buy one for $7 on Amazon? The actual outcomes were different to what the market had expected. Electronics competitors exited, the weaker ones. Godfrey's just recently, but we've seen Retrovision, Joyce Main really fall by the wayside. JB Hi-Fi continued to take market share, and Amazon also continued to grow. So these long-term threats can offer outstanding opportunities. And when you look at valuations, here's what you see. Before Amazon came, JB Hi-Fi would trade on 14 times PE. During that panic stage, which I think where we are now with ResMed, JB Hi-Fi traded on 12 times, as low as 10 times PE. And then today, Amazon's bigger than it's ever been. JB Hi-Fi's earnings are as high as they've ever been, and yet the multiple is also one of the highest in the past decade. So it just shows the market can change its mind about some of these threats, and when companies deliver and they're market leaders, great returns can be made. I might change gear now and talk the world's largest gold miner, Newmont. It's a company we own, but the setup for gold is pretty reasonable. The gold price has been strong. There's multiple reasons for it, but one is, decline in confidence in fiat currency. I'm not going to go into that now, but it's fair to say, when you look at Newmont in the blue line and just how strong the gold price has been, and these are based 100s, gold price is up more than 20% in the past 2 years, and yet Newmont is down close to 30%. Now, typically when the gold price rises, gold miners rise even more. So this is a very large dislocation. We increased our position in the fund in February. It was one of our biggest detractors, in fact, over the last 6 months. And it's fair to say market has put Newmont in the sin bin. But we believe there's reason for optimism, and Newmont is a very attractive business to invest in. The starting point is that they are the BHP of gold mining. They own more than half of the world's tier 1 assets. Now, tier 1 assets, you can see them here. They're the ones with the blue N on top. Tier 1 assets are large, low cost, long life assets. These are the kind of businesses you want to buy, and when they're diversified, they typically come with a higher valuation. It hasn't been the case with Newmont, and we believe the market's massively overlooked the fact that Newmont management is getting much more shareholder friendly. Newmont management are instilling discipline. The first is a fixed $1 per share dividend. That puts it at just below a 3% dividend yield. They fixed the growth capital budget, so no more when prices are good and there's a lot of cash flow fluttering all the cash flows away on new growth projects. The growth capital budget is fixed. They're selling non-core assets. That's underway now, and all excess cash flow, all of it, will go into buybacks. Newmont offers one of the most compelling investment opportunities we can see in the market today, and we believe the market really has slept on this one. So at the outset, I wanted to talk about some of the challenges the portfolio's had and why we believe some of these things will revert. Banks have performed exceptionally well in the past year, but we don't see a reason why, and we believe the outlook still remains very challenging for the banks. ResMed has an existential threat in weight loss drugs, but as the market leader and the second player out of the market, we believe it offers exceptional growth at a very value price. And finally, Newmont, as it's lagged the gold price, it's gotten more shareholder friendly. We believe there's strong alpha available in Newmont as well. Thanks for your support, and thanks to Morningstar for putting this on, and really invite you to continue to support the Firetrail Australian High Conviction Fund, where we run a concentrated portfolio with a proven track record. And with that, I'll hand back to Kyle.
Thanks very much, Blake Henricks from Firetrail. Blake's going to be available at the end of the session where we'll do Q&A. And as a reminder, you can use the Q&A bubble in the Investor Hub if you've got any questions for Blake. Well, next up, I'd like to introduce Michael Bell, who is CIO of Solaris Investment Management, one of Australia's most consistent performing active managers here in the Australian market. They've actually outperformed 17 of the last 23 years, so an exceptional track record there. Michael's going to run you through some of their key stock ideas and portfolio positioning. Michael, thank you so much for joining us.
Oh, it's great to be here, Kyle, and appreciate it. And thanks to Morningstar. If I think back to October last year when Morningstar had their Morningstar Direct conference, and where bonds were at the end of that month, we had bonds trading at about 5%. The market was pretty bearish in terms of where interest rates were going, the lack of interest rates falling. And then if we fast forward 2 months, we had interest rates at the end of December down to 3.9%. And that was the impetus for the stock market starting to take off. And over the last 6 months, we've seen the stock market up aggressively. Now, part of the reason why we saw the stock market up, in addition to the move in rates, and rates now are sort of halfway in between there at about 4.5%. Part of the reason is we saw money coming out of China and being redispersed back into Asia, including Australia. And so we were witnessing that money come into our market. And a lot of that money was coming into the top 100 companies, in particular the top 20. In addition to that, we heard about a number of the big super funds in Australia sitting on large amounts of cash, expecting the stock market to underperform with potentially a recession in Australia, and that didn't happen. And a number of those super funds appear to have put that money to work. As a result, we've seen the stock market very, very firm. And in this chart, you can see up on the screen here, you can see various sectors of the market. You can see the performance in yellow, and you can see the change in earnings for each of those sectors in blue. And what we like to see in the long term as investors is we like to see a correlation between both earnings and share prices. And in the last 6 months, you just haven't seen that. And a lot of those, in terms of excess share price movements that you can see in the chart there, come from high beta names, growth names, and the banks. And then the poor performers have been the low beta names, the defensive companies, and the resource companies. So it's really, really interesting there. Interestingly, on banks, you see the massive performance there, and Blake talked about banks. They're up 20-odd%, led by CBA, but the downgrades over the last 6 months have been about 4%. And if you want to think about any green shoots in banks, if there's any, we've had numerous conversations over the last few months with CEOs of the top 4 banks, with Macquarie Bank, with mortgage brokers, with neobanks, and they're suggesting that the competition in mortgages and both deposits and lending is just starting to ease slightly. So I guess there's a little bit of positives coming into banks, but overwhelmingly the market is priced in a lot, and a lot of that has come because of the flows we've seen into the market. If I want to pick on a particular sector, I'm going to pick on growth companies. And when I think about growth companies as we class them here at Solaris, I'm thinking about 40 companies in the ASX 200. And the performance, as you can see in the blue line there, has been enormous over the last 6 months. They've rallied about 30 to 35% as a group. Yet that orange line, which is the earnings changes, has hardly seen any change. So that's the 2025 earnings. And if you look at 2026 earnings, it's the same trajectory. Not a lot of change in earnings. So what we're seeing across the market, both across those growth sectors, banks, the cyclicals X resources, is we're seeing a massive re-rate, and it's been particularly big in terms of growth companies. So what are we doing here at Solaris as a result of what we're seeing in the market and the big re-rate in certain parts of the market? Well, you can see that chart on the bottom right-hand corner is our growth value bias. So the orange is the growth bias within the portfolio. In 2022, the market saw a big derate of growth companies, and that was a fantastic opportunity for the Solaris funds, the Solaris Core Fund, the Long Short, the 1/3 Fund, and the Income Fund to increase their positions in growth stocks. Now, what I would say about our income fund is it's different to a lot of other income funds out there. We're looking to provide a good yield to our investors, but we also want to grow the capital of the portfolio. So it will invest in growth companies. So each of those portfolios has similar sort of trajectory in terms of growth bias as the core strategy. More recently, you can see the growth strategy starting to come off, and now we're quite neutral growth and value. And if growth continues to rally, you would expect our growth bias to turn negative. Now you can see 3 other companies on the slide there. You've got Goodman, Altium, and Cochlear, all companies that we've got in the portfolio, we've had in the portfolio. And in each case, the blue line, you've seen the share prices rally very, very hard, and the earnings not changing much at all, or at least not justifying the share price move. In the case of Goodman, our REITs analyst is pretty sad about selling his Goodman, but we've halved our position there, given the re-rate that it's had. It still represents good, reasonable value. We still like the company from a long-term perspective, but the size of the position had to change. We've reduced Altium and we've sold out of Cochlear. And it's not only the growth companies that are looking stretched at the moment as well. A number of companies you can see on the screen there are in those categories of top 50 companies in Australia that have seen the beneficiary of those flows. I'll point out Wesfarmers, which is in the top right. The orange line is the earnings changes to 2025 over the last year. And you can see all we've seen is downgrades to earnings in the case of Wesfarmers. Yet the share price continues to rally, and now it's trading above 30 times. So quite extraordinary. CBA has had an extremely strong rally as well, and it's had earnings downgrades. The whole banking sector's had earnings downgrades. So we've been reducing positions in a number of those companies, or we've been shorting them. So I've been pretty bearish on stocks in the market, and they really only represent about 40 to 50 companies in the market because it's been quite a narrow rally we've seen. So there are a number of really good quality companies out there, and one of them that we really like, and it's actually in the growth sector, is Life360. So that's a location sharing app company. That's a company that's they've got 66 million subscribers. They've been growing aggressively over the last 8 years, and more recently it's been very, very strong. And importantly, revenue's been growing as well. It's a company that's got a great balance sheet. They've got cash on the balance sheet, and they now are producing positive operating cash flow. Importantly for Life360, you can see that revenue growth has been quite strong, but only 2 million of the 66 million subscribers are fee-paying subscribers. So there's a fantastic opportunity to turn on the tap for Life360 in terms of revenue and profit growth. So with those 2 million subscribers, what's the opportunity with the 2 million subscribers? Well, the opportunity with those guys is to continue to grow those 2 million subscribers and convert the 66 million subscribers to that fee-paying model. In addition to that, we've got the opportunity in terms of targeted advertising. And so if more people stay on the freemium model, the company can use targeted advertising to increase revenue. They've also got the opportunity to increase targeted insurance as well. So there's a lot of opportunities for Life360 to turn on the tap, increase the revenue, and increase the profitability of the business. Another company we like is Aristocrat. Now, this is a growth company that hasn't been priced for perfection. You can see in the bottom right-hand corner, you can see the chart that it's trading at a 14% discount to market. In terms of share price performance, looking at the chart on the top, you can see that it's actually underperformed in the last 6 months. Yet, unlike the other growth companies, it's had positive earnings changes over that time. And what do we like about Aristocrat? They're a leading, they've got a leading position in their area of expertise. They've got a strong balance sheet. They've got strong free cash flow with ongoing buybacks. And importantly, we're expecting 3-year EPS growth of 10% per annum. And as I said, it's trading at about a 14% discount to market. So in summary, we've seen strong share price performance from a number of companies in the market. There's been little earnings growth to support that. In particular, I picked on growth companies that have been very, very strong, and they have generally had little earnings support to support that re-rate. And our response to that has been to reduce our growth exposures, which is what you'd want. And that's across all our portfolios, our core strategy, our long shorts, and our income funds. Opportunities still do exist in the market. And as I said, that's been a narrow rally, but we really like Life360 and Aristocrat. I really want to thank you for the opportunity today, and also thank you for your support.
Thanks so much, Michael. And I might get you to, if it's okay, if you can take that off the share screen now, and I'll invite Blake to come back for Q&A. Michael, while Blake's joining us, I might start with you with a question around costs. We've seen Australian companies dealing with higher rates and also higher costs. When you're talking to Australian companies, how are they navigating this environment?
Yeah, so a lot of the investments that we make, Kyle, are in those companies that have good pricing power. So they've been, well, costs have been going up, and they've been able to pass on a lot of those higher costs onto the consumers. So it's been one of the qualitative factors that we look at in our process is the industry structure in which a company operates. And so investing in companies that have got good industry structures at the moment is really important, because the higher costs coming through is definitely a factor. But what we have seen, I guess, on the ground is a slowing of those costs. And so the inflation is starting to slow for companies in general, but pricing power is still important in our market. Companies like Cube, Worley, Goodman Group, they're all companies that have got good pricing power and can pass on those costs.
Blake, Michael mentioned the consumer there, and that businesses have been passing prices on to the consumer. What are Firetrail's views on the Australian consumer today?
As we sit here today, I'd say the consumer's weakening. We've been over to New Zealand recently, and any of you on the call who have friends or family in New Zealand know just how tough that environment is. They were one of the first to go with higher rates, and it does take some time to have an impact. So I think New Zealand's at the toughest end. I think Australia's, the feedback we're getting is, certainly March, April, May, things really started to turn. And so things are definitely slower. I saw Super Cheap Auto the other day. So they own the Rebel franchise. They said, we're still seeing reasonable foot traffic. So foot traffic's sort of flat to growing, but the number of items that people are putting in their basket is decreasing. And so that indicates to us, not a collapse of the consumer, but certainly things are just a little bit tougher.
And you mentioned gold in your presentation, Blake. I'd love to get both of your views on resources and where you're seeing risks and opportunities. Blake, let's stay with you to start, and then Michael, heads up, I'll throw that question to you as well.
Yeah, so when it comes to resources, we've got a couple of plays in the portfolio. So more so on the base metals. So something like a South 32, which if you look at the mix of the business, 80% of it is copper and aluminium. And both of those are going to be used heavily in the energy transition and lightweighting of vehicles. And it's also coming from a very low point of earnings. So that's one that's quite interesting to us, particularly versus the iron ore names. But equally, some of the explosives companies, like an Incitec Pivot. So what they do is they provide explosives to copper miners, coal miners, all kinds of miners around the world. You need explosives if you're going to mine. And I think what's really interesting with that kind of story is production isn't that volatile. If you look across the globe, generally rocks blown up will grow at probably 1% per annum. But the trick is that mines are getting deeper and harder to access, and that's going to mean more material moved over time. And so some of those mining services companies are also quite interesting to us.
Thanks, Blake. Michael, how are Solaris looking at the resources sector at the moment?
Yeah, so in the metals and mining space, there's a few things that we look at before we invest in companies, and we want to make sure a company's got a good balance sheet to see them through whatever period of low prices or high prices there might be. So balance sheet's really important. So have they got a balance sheet? Low cost producers are important to us. Producing in Australia is important, so predominantly producing in Australia. So there's sort of factors that we look at before we invest. Right at the moment, in terms of investing in metals and mining companies, we're looking for companies that have got good growth. And so companies that interest us at the moment are companies like Pilbara Resources in the lithium space. Now, Pilbara's is growing aggressively, but they've also got a very strong balance sheet to fund that growth. So we'd never invest in Pilbara if they didn't have that balance sheet to fund it. Lithium prices are low at the moment, and so they can withstand a period of low prices. We're also invested in Lynas, and we do own gold companies like Firetrail do. So we're invested in Northern Star and Capricorn. But I guess in terms of metals and mining companies, it's more about growth from here and growing the base of the business. In terms of energy companies, we do like Worley. So we like Worley for the extreme growth they've got over the next 10 to 20 years, particularly in sustainability. They've got a fantastic opportunity there. I guess their biggest thing that could hold them back is the amount of people that they can source to do the work. And at the moment, that's looking very, very comfortable. But that's a company we expect to see good double-digit growth for the foreseeable future.
That's excellent. Michael, Blake, we've got 1 or 2 minutes left. So just a quick fire one for both of you. Michael, investing in Australian equities, if you're an advisor building an Aussie equities portfolio at the moment, going into the August results season and beyond, what's one key message you'd have for asset allocators specifically to Aussie equities at the moment?
Yeah, so the key message is there still are plenty of opportunities in the market. Headline, it might look a bit expensive, but for active managers, it is there's plenty of opportunities we are seeing out there. And you don't want to constrain yourself to one single style, whether it's growth or value. You want to be with a manager that can go wherever the opportunities are. And at the moment, for us, we've seen growth starting to get a bit expensive, and so we're seeing many opportunities in value. So as a manager, we can take advantage of the opportunities that are there at the moment in terms of the market.
Well said. Blake, final thoughts for investors allocating to Aussie equities?
Yeah, for us, it's not being tied to the benchmark. I mean, you saw some of Michael's charts; they were very compelling. The earnings per share versus some of the share prices. What's happened in the past 6 months really isn't normal. It could sustain for a period, but you can also see a very sharp change to that. And so things like banks and Wesfarmers and some of these stocks that are well-known names but have moved beyond their fundamentals actually present risky propositions in our view.
Excellent. Both presenting the case for active management there. Blake Henricks from Firetrail, thank you so much for your time, experts in high conviction investing. And thank you to Michael Bell from Solaris, who invests across Solaris Long Short, Solaris Aussie Income, and the Solaris Core Fund. And thank you for joining us for the Morningstar Meet the Manager with Firetrail and Solaris.
Thanks, Kyle. Thanks, Blake.
Yeah, thanks, Kyle. Thanks, Billy.
Cheers.